Most business owners treat growth like the answer to everything. Revenue's down, let's grow. Cash is tight, we need to grow. Something feels off, let's grow our way out of it. But I want to talk about what happens when growth is actually the thing making it harder to run your business. Sounds counterintuitive? That's because it is. Just stick with me here. Look, the assumption in almost every business is that more revenue fixes whatever's wrong. And a lot of the time, honestly, that's true. More money coming in does solve a lot of problems. But there's a specific situation where chasing more revenue makes your cash position worse before it gets better. And what makes it so dangerous is that it doesn't always feel dangerous. Everything looks fine on paper, the P&L confirms the growth, the team's excited, and the cash problem is building quietly in the background where nobody's looking. That's what this is about. Not stop growing, just understand that growth actually costs before it shows up as a surprise down the road. In the last video, we talked about why a profitable business can still feel broke. Short version, profit is an accounting measure, cash is what's actually in the bank, and working capital sits in between. Growth doesn't fix that gap, it widens it. Quick one for anyone who missed the last video. Your P&L runs on an accrual accounting basis. Revenue shows up when it's earned, not when it's actually collected. So you can have a great looking income statement and a really stressful bank account at the same exact time. Both things are true simultaneously. Working capital is what sits in the middle. Money owed to you, money you owe out, and what's tied up in the pipeline. When the business is stable, that layer is typically predictable. You kind of know what to expect. When you grow fast, though, it stretches. And if you're not watching it, that stretch quickly can become a squeeze. That's what we're getting into today. Picture a professional services firm. Could be an agency, could be a consulting shop, doesn't matter. They just closed their best quarter ever. New clients, expanded contracts on existing business, pipeline looks genuinely full with strong leads. Fast forward, and 6 months later, the founder is stressed about making payroll. Okay, let's pause. That's a quick shift from a great quarter to worrying you won't be able to pay your team on time. So what happened? Nothing went wrong, so why does it feel like something did? When those deals closed, everything felt like it was clicking. The team was celebrating, they'd been grinding for a quarter like that, and it finally came together. Everyone's optimistic, and leadership is making new hires. And on paper, it still looks great. Revenue's up, margins are holding, clients are happy. Nobody's sounding an alarm. But the founder starts doing more mental math than usual, watching the balance a little more closely, not panicking, just more aware. And there's this nagging feeling of we should have a lot more cash than this. And here's the frustrating part. They can't point to the moment it started. It wasn't one bad call, wasn't one client who didn't pay. It just kind of drifted, slowly, over a few months. This is usually when the founder sends that email to the accounting and finance team. We all know the one. Something doesn't feel right. Look into it and get back to me. No specifics, no numbers to point to, just a gut feeling. And honestly, that email is really hard to work from on the receiving end. But if you're on that finance team, try to put yourself in the founder's shoes for a second. They're not being difficult. They're picking up on something real. The business isn't in trouble, but it doesn't feel like a business that just had a record quarter either. And that gap between what the P&L says and what the bank account feels like, that's exactly what we're unpacking. When you grow, you spend before you collect. You hire before the new clients are fully onboarded. You buy the tools, the software, the capacity before any of that turns into revenue. And if your collection cycle is 45, 60, 90 days out, that gap can quickly and quietly compound. Every new dollar of revenue is a dollar you've earned on paper that hasn't hit the bank yet. As we know in accrual accounting, revenue gets recognized when it's earned, not when it's collected. So the P&L is showing growth, the cash flow statement is telling a different story. Every growth move requires investment first, right? You can't take on more clients without more people, more tools, more capacity. And all of that costs money today, not in 60 days when the revenue starts flowing. Today. So you're essentially making a short-term loan to your own business every time you grow. You front the cost and wait to get paid back through revenue. That's not the problem. That's just how growth works. The problem is when the lag gets big enough that you really start feeling it. And here's where it can get confusing. Your income statement recognizes revenue when you've fulfilled your contractual obligation with your client. For those who want the technical term, that's ASC 606. But this isn't an accounting course, so we'll leave it there. The point is, that recognition happens before cash hits. So you can have a fantastic month on paper and a genuinely stressful month in the bank at the same exact time. Both are accurate, they're just measuring different things. Most business owners spend way more time looking at their P&L than their cash flow statement. And honestly, that makes sense. The P&L tells a story of how the business performed, and let's be real, we all love seeing those upward trends. But the cash flow statement tells you what you can actually do right now. If you're only looking at one, you're only seeing half the picture. Here's the part that really catches people though. The faster you grow, the bigger the lag gets. Double your revenue, but keep the same collection cycle, and you're also roughly doubling the cash sitting in receivables at any given moment. The ratio didn't change, however, the dollar amount sitting inside your account did. Here's a real example. Consulting firm wins a 6-month retainer. They staff for it in month 1 with 2 experienced hires which started right away. But the first billing milestone doesn't hit until end of month 2 after the first deliverable is satisfied. They're paying salaries for 30 plus days before a single dollar of revenue comes in from that client. Now close 3 deals like that in the same quarter? That lag is running simultaneously across all 3. Cash going out is immediate, cash coming back is 30, 60, sometimes even more than 90 days behind it. Again, nothing went wrong. Good hires, good clients, good decisions, but if you're not watching the timing, it shows up as a cash problem that feels like something broke, when in reality nothing did. So where does the cash actually go? There are usually 3 specific places it gets absorbed during a growth phase, and most businesses are really only tracking one of them. First one is hiring ahead of revenue. You can't wait until the work is there to bring people on. By then, you're already behind. So you staff in anticipation. That's the right call, but those salaries start on day 1. The revenue they help generate starts later. 2 experienced hires at $80,000 each, that's $13,000 a month in new payroll before they've contributed $1 to the top line. Stretch that to a 90-day ramp, and that's $40,000 out the door before it comes back. Do that across 4 or 5 hires in a growth phase, and it compounds fast. The second one is AR expansion, and this one's sneaky because it genuinely looks like a good problem to have. More clients means more outstanding invoices. If your average DSO is 45 days and revenue doubles, your AR balance will logically roughly double as well. The ratio stayed the same, but the dollar amount sitting in receivables instead of your bank account just got a whole lot bigger. And if collection discipline loosens a little during a busy stretch, which in practice it usually does because everyone's heads down on onboarding, DSO creeps up on top of that. Going from 45 to 60 days DSO on $2 million in revenue is $83,000 in cash at any given moment that's sitting in AR versus the bank account. That's not a rounding error. That can be truly material for most businesses at any stage. Third one is infrastructure and fixed cost creep. Growth almost always comes with a step up in operating costs. New software, upgraded tools, bigger space, and new compliance requirements that come with scale. Each one looks totally justified on its own. Collectively, it's a significant outflow that doesn't show up cleanly in any single line item. And the income statement might smooth some of it out through depreciation and amortization, but the cash left when you sign the contract. The accounting spreads it. Unfortunately, the bank account doesn't. So here's the check. Pull your last 2 years of financials. Find your net income and your cash from operations, which can be found on the cash flow statement. If profit went up, but operating cash flow didn't keep pace, working capital is absorbing the difference, and that's your answer. Then look at your AR balance. If it's growing faster than revenue, your customers are holding your cash longer than before, and that's the leak. 2 comparisons we can check. That's the whole diagnostic. You don't need a consultant for this. You need 15 minutes and your own numbers that you're already familiar with. First, profit growth versus operating cash flow growth, year over year. Put them side by side. Profit is up 30%, operating cash flow is up 10%. Something in working capital is eating the difference. That's your answer. Next, let's divide your current AR balance by your average monthly revenue. That'll get us a rough DSO number. Compare that to 12 months ago. If it went up, collections are slowing. Customers are sitting on your cash longer, and you probably haven't noticed because everything else looks fine. Both of these numbers are already in your accounting software. QuickBooks, Xero, Sage, whatever you're on. 2 clicks, the data's there. Most people just aren't looking at it through this lens. The owners who catch this early are the ones who make it a habit of checking these numbers at least quarterly, not just at year end when the accountant sends the report. Quarterly, 15 minutes, and once you've done it a few times, you start to feel when something's drifting before it becomes a real problem. So what do we do about it? The fix isn't to stop growing. The fix is to fund growth intentionally and watch the lag between spending and collecting. Invoice faster. Get deposits on new engagements. Extend your payables where you can. And run a cash flow forecast, not a P&L forecast, so you can see what's coming in before it arrives. The most useful tool here is a rolling 13-week cash flow forecast. Not a revenue projection, a cash forecast. Actual money in, actual money out, week by week for the next 90 days. Most businesses run P&L projections that treat that as their financial visibility. It's not the same thing. A P&L projection tells you how the business should perform. A cash forecast tells you when you're going to feel the squeeze and how deep. If you can see a trough coming 3 months out, then you have options. Invoice a client earlier, pull on a payment that's been sitting, draw on a line of credit if you have one available. 2 weeks out though, those options start disappearing fast. The forecast buys you time. And time is the thing that turns a cash problem into a manageable situation instead of a crisis. On the collection side, deposits are massively underused in professional services. Starting a new engagement, ask for 25 to 30% upfront. That's standard. It's not aggressive, it's just good business. And payment terms are negotiable too. A lot of companies are sitting on net 60 because that was the default when the contract got signed and nobody pushed back. If your client would pay net 30, ask for it. You'll get it more than you think. We're going to do a whole video on the cash forecast because it deserves its own time. For now, if you're not running one, start. Even a rough spreadsheet beats flying blind. Decline is visible and hard to ignore, but growth feels like the solution. And that's exactly why it's dangerous when it's not managed, because by the time you feel it, you've already been funding it for months. That's the whole thing here. Growth isn't inherently safe, it just feels safe. The P&L confirms it, the team's excited, and the cash issue is building in the background because nobody's watching the timing. The businesses that handle this well aren't necessarily smarter or more sophisticated, they're just watching the right things. Profit tells you how the business performed, cash tells you what you can actually do with that performance. You need both. If you take one thing from this, go run those 2 comparisons this week. Profit growth versus operating cash flow growth, AR growth versus revenue growth. 15 minutes. You'll either confirm things are fine or you'll find something worth paying attention to. Drop your results in the comments. I genuinely love to see what you find. Next time, I want to get into something that trips up a lot of businesses at the numbers level, specifically why your revenue figure and your sales activity don't always move together in the way you would expect. Bookings, billings, revenue, 3 numbers, 3 vastly different stories. If you've ever had a month where the sales team was celebrating and the finance report didn't quite match up, that's exactly what we're covering next time.